Folks, if you only watched a ticker price today, you missed the real event entirely. You focused on the digits but slept on the signal. You watched the scoreboard while the stadium itself was burning down. What happened today wasn't about silver at $79 or $80. The true story wasn't a candle, a chart formation, or a technical support level. The real story was a name that holds more weight than any spot price print you will ever witness: Elon Musk. While traders fought over pennies and bots scalped microseconds, the planet's biggest industrial buyer did something crucial. He spoke up. Not via press release, not through a hedge fund, but in 4 simple words posted for the whole world to see. This is not good. To the untrained, it looks harmless, almost casual. Yet markets aren't moved by words. They are moved by the man who says them. This wasn't a media talking head fishing for clicks. This wasn't a fund manager pumping his book. This was the CEO of Tesla, SpaceX, and the largest solar outfit on Earth, a titan whose whole empire runs on one irreplaceable element: silver, the most conductive metal known to physics. The metal that electric vehicles fail without, solar panels underperform without, and advanced tech simply cannot exist without. When Elon Musk says that this is not good, he isn't talking about price. Price is nothing to him. He has liquidity. He has capital. What he lacks is infinite access to physical metal. Availability is the problem. Supply is the problem. And supply, once snapped, doesn't react to cash. It reacts to geology, logistics, and time. This is the moment the script flips. For years, silver was treated like a financial toy, a paper battlefield for longs and shorts. That war ended today. Because right now, silver isn't a speculative asset. It is a survival asset. The financial war is done. The industrial war has begun. If this breakdown changed your market view, make sure you subscribe to the channel. Comment 1 if you're seeing the signal behind the price, or 2 if you're still just watching the scoreboard. Type 1 to move to chapter 2, type 2 to stop right here. To get why those 4 words matter, you must grasp what most traders miss. Industrial buyers don't play the game financial speculators do. A hedge fund can click a mouse to close. A market maker can roll a contract. A bank can cash settle and walk away bruised but living. An industrial giant lacks that luxury. They cannot swap spreadsheets for atoms. Tesla cannot build an electric car without silver. SpaceX cannot make avionics without silver. High-efficiency solar panels cannot exist without silver paste. This isn't an opinion, it's physics. Conductivity isn't negotiable. When supply tightens, industrial users aren't bullish or bearish. They are exposed. Here is where the misunderstanding starts. When people say Elon Musk worries about silver prices, they show they don't get his problem. He isn't long silver. He is short it. Deeply short. Every car sold, every battery installed, every panel deployed is a future debt of physical metal that must be delivered, not paid off. Banks can lose cash and survive. Factories lose metal and shut down. If a bullion bank is short silver and prices spike, they wire cash and move on. If Tesla is short silver and supply vanishes, the line halts. Revenue stops. Stocks crash. Empires shake. That is the asymmetry that matters. This is why Musk's statement wasn't commentary. It was a warning shot. He signaled every other industrial CEO that the era of trust is dead. Just-in-time inventory only works when chains are honest and liquid. When shelves empty, just-in-time becomes not in time. And when that hits, buyer behavior shifts instantly. Companies stop optimizing for price. They start optimizing for survival. Orders get doubled, then tripled. Inventory is hoarded, not traded. Metal is pulled from the future and locked away. This is how shortages become crises, not because of speculation, but because of fear. Once that fear hits the industrial system, no algorithm can stop it. Because this time, buyers aren't betting on charts, they are protecting production lines. The moment industrial fear takes root, the market stops acting like a market and starts acting like a vacuum. This is where traders get blindsided. They expect gradual moves, orderly repricing, rational dips. That isn't how supply shocks work. When survival is the goal, price is secondary, and liquidity vanishes first. Consider what happens next, not on a chart, but inside a boardroom. A procurement officer reads Musk's words and feels their stomach drop. They don't wait for proof. They don't wait for CNBC. They grab the phone. They call their refiner. They say, double our order. Then they pause and say, no, triple it and ship it to our vault, not yours. Now scale that behavior across Apple, Samsung battery makers, defense firms, and solar giants. This isn't coordinated. It doesn't need to be. Fear is the coordination mechanism. Each buyer knows he who hesitates loses access. This is how inventory hoarding cycles start. Not to make money, but to stay alive. When industrial giants enter the market like this, prices don't climb politely. They jump. They don't bid up by cents. They sweep the books. Everything at 79 is gone. Everything at 85 vanishes. 90 becomes irrelevant. The market doesn't ask what silver is worth. It asks who still has it. This is why today's move wasn't a bubble. It was a repricing of reality. Algorithms get this dynamic better than humans. They know Musk doesn't speak casually about supply chains. He has better data than any trader, analyst, or regulator. If he sees a shortage, it already exists. Here is the dangerous part. Musk isn't just an observer here. He is a catalyst. History shows us what happens when he highlights scarcity. When Tesla touched Bitcoin, price doubled in weeks. Now imagine what happens if Tesla decides it cannot trust the market at all. If the next headline isn't a tweet but a filing. If Tesla secures direct mining exposure or starts physical stockpiling, that isn't bullish, that is structural. At that point, $100 isn't a target, it is a floor. Because once industrial demand turns defensive, there is no price ceiling, only availability. What makes this moment truly dangerous is that Musk's worry isn't abstract. It isn't a long-term theory or slow trend. It is tied to a specific date. A hard deadline most of the market is ignoring. A date only days away, January 1st, 2026. On that day, silver market rules change permanently. China, the world's top refiner and processor, is starting a new export licensing system. To the casual eye, this sounds like paperwork. In reality, it is a blockade. And blockades aren't designed to manage trade. They are designed to control power. We read the fine print, the requirements are surgical. To export silver out of China, a firm must now prove massive annual production and tens of millions in credit lines. These limits aren't arbitrary, they are a guillotine. Hundreds of small and mid-sized refiners, traders, and brokers get disqualified instantly. Overnight, they are cut off from Western buyers. Their metal doesn't disappear, it stays inside China. It floods domestic chains and feeds Chinese factories directly. Solar giants, battery makers, EV champions get priority access. This isn't regulation, it is resource nationalism. The playbook China used with rare earths is back this time with silver. Timing is everything. This policy hits exactly as the global silver deficit reaches critical mass, as inventories thin, as demand spikes. China is locking the door just as the building catches fire. Musk sees this clearly. He knows even silver mined in Mexico or Peru often flows through Chinese refineries. When that gate shuts, the chain snaps. The world won't lose silver evenly, it splits. One price inside China where metal exists, another price outside where panic starts. Arbitrage dies, trust evaporates, and Western industry is left fighting for scraps in a market that just lost its main supplier. This is not theory. This is a deadline, and deadlines change behavior fast. To grasp the scale of what's coming, you need to face a reality. Wall Street has dodged for years. The silver market was broken long before China locked the gates. Export controls aren't the cause of the crisis, they are the match. The fuel has been piling up for half a decade. For 5 straight years, global silver use has topped global production. This isn't a temporary glitch. It is a structural deficit. In the last year alone, demand surged past 1.2 billion ounces, while mining supply stalled barely above 1 billion. The difference didn't vanish. It was stolen from the past. We filled that gap by bleeding above-ground stockpiles, emptying vaults in London and New York, and maxing out recycling flows. But stockpiles aren't mines. They don't regrow. You can only drain a tub until you hit the porcelain, and right now the scraping has started. Usually markets handle deficits with substitutions. Copper tags in for aluminum. Palladium takes over for platinum. Analysts guess silver follows this script. It won't. Silver is irreplaceable. It is the apex conductor. It is the most electrically conductive element known to man. No alloy works as well. No substitute maintains efficiency without a heavy compromise. For high-tech electronics, solar panels, EV power systems, and data grids, absolute efficiency is mandatory. A tiny conductivity drop means heat signal loss and failure. Good enough never wins the race. And the global economy is speeding up. That's why an industry now devours over half of all minted silver. It isn't just a precious metal for jewelry anymore. It's a strategic necessity, the lifeblood of the green shift. You can't electrify the planet without burning through massive, staggering stockpiles of it. When Elon Musk checks the charts, he sees the reality. The deficit isn't shrinking, it is expanding. And with China's supply set to disappear from the West, the math becomes lethal. Here we hit the most dangerous scam in the financial system, the moment this tail shifts from supply and demand to pure structure. The paper game. For decades, silver wasn't priced by miners, it was priced by derivatives. Paper stacked on paper, built on one wild guess. No one would ever demand the physical metal all at once. One specific number exposes this whole rig completely, the paper-to-physical ratio. Right now, for every ounce of real silver in a registered vault, hundreds of paper claims exist, demanding that same ounce. Visualize it. One coin on the desk, hundreds of receipts floating around. For 40 years, this con worked because claimants were just gamblers. Hedge funds, traders, algos. They traded paper and never demanded delivery. The music played on so nobody saw there was just one chair. But today, the music has died. Not due to retail stackers, but because industrial giants walked into the room. When giants like Tesla, Apple, and Samsung stop wanting exposure and demand possession, the rig snaps. Paper contracts can't run factories. Cash settlements can't build EVs. At that point, the market exposes itself as a fractional reserve scam pretending to be physical reality. When they demand delivery, only one holder gets the metal. The rest get a check settled at a price that's gone. Fiat currency replaces scarcity. That is how real wealth is transferred without any headlines or riots. The inventories confirm this fact. Registered supplies have drained for years. Buffers are toasted. In some spots, usable silver covers just weeks of demand. One surge, one break, and the shelves go totally empty. This isn't a market nearing a collapse. It is a system that is already failing, still faking that it is stable. When the paper scam starts to crack, the market splits in two. This is where most investors get lost watching one price when two realities exist. The screen price versus the street price. The price of promises versus the price of real metal. In a real market, arbitrage keeps them aligned. If silver is cheaper in New York than Shanghai, traders buy low ship, the metal sell high and close the gap. That mechanism is the gravity of global pricing, but gravity only works when metal is allowed to actually move. And as of now, it is not. China's export controls cut the artery. Once silver enters China, it doesn't leave. Licenses restrict the flow and hoarding replaces trade. Arbitrage is dead, and when arbitrage dies, the prices diverge. This is why the Shanghai premium matters more than the COMEX lie. In China, buyers pay more not because they're crazy, but because they're closer to the manufacturing base. They see shortages first. They know the order books. They get the timelines. They aren't buying to speculate. They are buying to survive. When physical premiums explode, the market is screaming that the spot price is a lie. The screen price assumes infinite supply and cash settlement. The street price reflects real scarcity, and scarcity always wins out. This split is the future bleeding into the present. The higher price in the East isn't an anomaly, it is a warning. Western vaults are draining, and once that buffer is gone, the Western price won't drift upward. It snaps hard. That's why today's price isn't expensive. It is discounted. It's priced for a world that no longer exists, and the window to buy at that discount is closing fast. As the split accelerates, pressure builds where the system is weakest. Not in Shanghai where metal lives, but in NY and London where promises outnumber ounces. This is where the squeeze gets violent because every short position in the West just became infinitely more dangerous. In the past, a short seller had an escape hatch. If delivery pressure rose, they could source metal globally, call a refiner. Ship bars, relieve the stress, that valve is closed now. China was the release mechanism, and it is gone. This turns Western exchanges into isolated islands. When a NY bank is short silver and faces delivery demands, there is no external supply to save them. They are trapped between margin calls and empty vaults. This is how squeezes go vertical, not due to speculation, but because there is nowhere to hide. Every paper smash backfires now. When prices are pushed down on screens, physical demand surges. Buyers step in aggressively, draining what little inventory remains. A paper discount in a physical shortage isn't suppression. It is a clearance sale on a totally empty shelf. This is why volatility explodes near the end of a cycle. The market isn't unstable because it's emotional. It is unstable because it is lying. And lies collapse suddenly. The Western market is nearing the unobtainable phase. Dealers delay shipments. Premiums widen. Stock vanishes without warning. The buy button doesn't fade out gradually. It disappears overnight. And when that happens, price discovery ends. The question is no longer, how much does silver cost? It becomes, who already has it? When scarcity hits this stage, it stops being a commodity story and becomes a financial one. This is where silver hits the broader system because silver isn't just metal. Inside banking, it is collateral. It is leverage. It is a hidden load-bearing beam in a structure built on confidence. And confidence once cracked does not heal on a schedule. It snaps hard, it spreads, and it infects everything it touches. Bullion banks didn't just sell silver once. They leased it, swapped it, rehypothecated it, and used it to secure borrowing across markets. 1 ounce backed multiple balance sheets. As long as prices stayed down and delivery was rare, the fake illusion held. But when metal is demanded, the leverage unwinds at once, like pulling a pin and watching the machine shake. A failure in silver delivery doesn't stay in the silver pit. It cascades. A bank that can't meet a margin call loses access to liquidity. Collateral is seized. Other positions are forced closed. Counterparties panic. Lending freezes. This is how a niche market becomes systemic risk, because the plumbing of finance is one big interconnected loop. This is why central banks respond the way they do. Not because they care about silver, but because they care about survival. When the choice is allowing a commodity to reprice honestly or preventing a banking seizure, they intervene. Liquidity is injected. Losses are socialized. The price signal is destroyed. But intervention has consequences. Printing fiat to save leverage devalues the unit of account. And when the unit weakens, hard assets rise. Every rescue accelerates the very move it is trying to suppress. This is the trap. The market understands this feedback loop. Heads scarcity wins. Tails fiat currency loses. Either path pushes silver higher, while trust bleeds out quietly in the background. At this point, the downside is capped by real physics. The upside is driven by policy. That asymmetry is what defines the final phase. This is where the story stops being about prediction and becomes about positioning. Not tomorrow, not next quarter, but structurally. What we are seeing isn't a rally, it is a reset, a transition from a paper-priced illusion to a physically constrained reality. And once that transition begins, it doesn't reverse quietly. The strategic lesson is simple, but uncomfortable. Price is no longer the primary risk. Access is. In a market where industrial users must secure metal to survive, volatility is noise. Pullbacks aren't signals to exit. They are stress tests revealing just how broken the system has become. Silver is being repriced from a speculative commodity into a strategic asset. That shift forces the price to rise, not to enrich investors, but to ration demand. High prices aren't excess, they are the cure. They slow consumption, stimulate supply, and expose leverage that never should have existed. For the listener, the mistake is thinking this is late. Late was when vaults were full and China was exporting freely. Late was when paper claims were trusted. Today isn't late. Today is the transition. And transitions are where the largest asymmetries exist. The disciplined response isn't panic. It is clarity. Understand what you own. Understand what is paper and what is real. Do not confuse liquidity with safety. Do not confuse screens with supply. History proves one fact: when fiat currencies finally break, under leverage, wealth rushes into hard assets that cannot be digitally printed. Silver is the ultimate intersection of wealth, shield, and industrial need. It is a rare opportunity to stack real weight. This is not a push to gamble on paper contracts. It is a call to see the big picture, to ignore the tamping and see the cycle. The age of fiat paper is dying. The age of physical silver is rising up. If this helped you see the truth, support us by subscribing, sharing, and dropping your thoughts below. The discussion is key because the apes waking up always happens before the massive price squeeze.